G'day and welcome to another Shitty TA with Shifty. Video edition this time. What I've got today is actually a little more than I can fit on my standard Twitter posts. I've had a few friends that live here, obviously, just requesting that I make a bit of an update on what I think is going on in the markets. Look, I'm no financial advisor, just going to get that out of the way now. Nor am I a professional. I've just been trading these markets for the past 3 or 4 years. Seen things come and go. Found some little quirks in the charts here and there that I find pretty helpful. And I've also learned quite a lot of other YouTubers. Not the ones with the open mouth thumbnails, but others, quite a few others. And I'll actually give a shout out to those guys at the end of this video because they're really, really worth watching. You'll learn a lot from them, and I highly, highly recommend them. But what I want to look at first is something I've seen going around lately. It is valid. It was valid in previous cycles. I don't know if it's going to be valid in this cycle because we do have Wall Street joining in, we have institutions joining in, and when you have institutional players jumping into the markets, things start to change. The rules no longer are standard, Elliott wave theory and things that we're used to. Things I was retracing to 618s, I was extending to 1618s. Things start to change. That's my theory, and we start to have to play by their rules, and we've got to figure out what their rules are to try and stay ahead of the game, and that can be difficult. But what I'll touch on first is videos that I've seen in relation to 1618 extensions from previous market cycles, and the 1618 extensions being the floor, I suppose, of maybe the first major corrections of the next bull cycle. So here's an example, right? This is the fib retracement from the peak of the 2017 bull run right down to the bottom of the bear market in 2018. Now, you can do this pretty easily, right? Just go and grab your fib retracement tool. Looks like this right here. There it is there. Jump into the settings, just click on it, you get that little cog, press that, and you can actually select if you wanted to project any extension fibs rather than just retracement fibs. So if you select 1618 right here, it'll project the 1618 upwards. Cool. Alright, so we've taken that measurement from the 1 down to there, and you can see a 1618 level right here. Now the argument is that in previous bull cycles, if you do that same thing, 2012, 2013 runs, you will find that the 1618 becomes a support level for kind of like a midway point, I suppose, in the next bull run. So what we'll do, got a ray right here. I'm just going to run this ray right there, right? Make a nice blue color, same as the 1618. I'll just zoom in and have a look. Righto. So this is where we're at. Okay. Right there. See that blue line? We're pretty much sitting on it. Right there. The blue line's running through the price on right now. And you can see that's exactly where the price is holding. We have wick through it. Right? But in general, the body is holding there for the time being. Okay, so at the moment, it seems valid. Now, issue I've got is what I raised before. Institutional players are in the game now. Wall Street's in the game. CME futures are in the game, and we're getting adopted real fast. And now we're playing league with the big ballers. Okay, so rules can certainly change, and this doesn't have to hold. This can break down, and I'll go into why a little later. But another thing I noticed that YouTubers, for some reason, either maybe missed or maybe don't know about, it's possible, is that when they're running fib levels on a logarithmic chart, right, they're running linear fib levels on a log chart. So what you got to do is open the settings, fib levels based on log scale. You see that there? I only just discovered this recently myself. Click that, bang, they change. But here's the interesting thing. Look where it is now. Let's draw another ray. Right here. Look where it is now. So the logarithmic 1618 fib extension marked the peak, or the current peak, right, of this, what everyone's calling a Wyckoff distribution. So that it's marked the peak, right? How scary is that? Cool. So that goes without saying. Now, we should be using logarithmic, Fibonacci tools, not linear on logarithmic charts. So to give you an example, looking at retracements of this current bull run. So we're marking from the low in March, the Corona dump, right? The C word that shall not be spoken, apparently, right up to the peak. So you notice if I switch off fib levels based on log scale, look what happens. Look at that, right there. So that now marks the 618 retracement as here, 27 grand. Okay, so that's where it marks the 618. But if we switch it on to account for a logarithmic chart, 618 is down to 11,000. Now, my theory is that what we just saw here is probably a wave 3 of a major run up. That's just what I think. I could be wrong, right? But I'm guessing this is a wave 3 of a major run up. So this could retrace to a 618. We don't know, but generally in the middle of a run up, so in your wave 3, usually it'll retrace to a 0.5. Right? It's not that often that it'll retrace to a 618. It does. It can, definitely. But you've got different theories. You've got your Wyckoff, you've got your Gann, and you've got your Elliott wave theories. Now, this leads me into what I've been noticing recently. So let's take a zoom in here. I'm going to switch over to the 4-hour chart here, and we're going to do a bit of a wave count. Okay. Now here's a cool trick for you. See how these waves look pretty messy, right? Let's switch auto off because it's annoying. See how that looks messy? I'll switch it back on for a sec, let it just even out, and maybe now we can switch it off. There we go. All right, so it looks messy, right? It's not clean. Jump into the Heikin-Ashi candles, and all of a sudden, trends become real easy to spot. This is why I love Heikin-Ashi candles. It kind of eliminates all the fuzz, right? It's like getting a nice, clean guitar tone, out of a slightly crunchy setting, if that makes any sense. Right, so we've seen a current peak over here, okay? This is a typical Wyckoff distribution. I know people hate that name now because they hear it so much, but I'm not going to call it, farts, rainbows, daisies, and sunflowers. It's a Wyckoff distribution. But, there is no reason why Elliott wave theory still can't apply here, right? And there's also no reason why Gann rules can't apply. See, institutional traders and whales, their main objective is to basically con the retail traders, which is you and I, out of our crypto. Now the thing is, if we're so used to sticking to one set of rules like we've had since 2017 and back, before the institutions came in, we're really easy targets, right? So we've got to try and adapt to what they're using, and they can mix and match rules if they want to, right? They can certainly mix and match rules. So here's an example. Wyckoff distribution, we've never seen one of these, I don't think, in Bitcoin until recently. But we've also got an almost perfect Elliott wave retracement happening here. Right, almost perfect. It's almost to the T. And you got an ABC corrective wave down. Now I'm going to get into the C wave in a bit. I have my doubts as to whether the C is actually done. It could still go down further. It's a high possibility, right? We don't know yet. But we've had our traditional Wyckoff here. We've got a 5 wave count down in the A wave. So we know that the A wave down in the Elliott wave correction has 5 impulses, right? They can be a bit hard to spot sometimes, but like I said, the Heikin-Ashi candles make it so much easier. So wave 1, 2, 3, 4, 5, right? Now you might be thinking, why is wave 5 bigger than wave 3? Well, the rules say that can happen as long as wave 3 isn't the smallest wave, right? As long as wave 3 is not the smallest wave, the wave count can be considered valid. So 1, 2, 3, 4, 5, right? Then we've got another ABC up. 1, 2, 3. Right, that leads us to the B. Cool. So that doesn't have to always be clean. It doesn't have to be just one wave, one wave, one wave. It can be kind of zigzaggy like that, right? But you just count the peaks. Peaks and troughs is what you count here. And then we've got the B down to the C. Currently, from what I've spotted, right, at least on the 4-hour time frame, we've got, let me just shift this over a little to that low, okay? 1, 2, 3, 4, 5. Currently. Cool. Currently. Now, is the downside action done? We don't know yet. Okay, we don't know. What we can look at is the indicators. So, for the moment, we've had lower lows on the price action, but higher highs on the indicators. Right? This is across quite a few time frames, so not just the 4-hour. We're looking at the 4-hour and the 1 day. We have had a positive divergence here on the indicators, on the RSI mainly and the MACD. They're the two that I mainly look at. They have pretty decent positive divergence happening there. Right, just ignore that line for the time being. That's more for the daily chart. So what we want to do now is try and figure out, okay, how can we maybe figure out how much more downside there is to go? So the way I like to do it is using a fib extension, right? Now, we know in this case, in this example here, so you've got ABC in that example, right? So there. So we can already see we have had a pretty huge downside here. Massive, massive. Generally in the last wave, you know, it's not as big as the first. Usually. Not always, usually. So I've marked some levels here. Now the way I've extrapolated these is I've done two things. First, I've taken a fib extension downways from the beginning of the dump down to the bottom of this dump and then back up to the next peak. Right there. Or sorry, back up to that peak here. Okay. That's given me this fib extension right here. Cool. Got a 0.5 level. We've got a 0.618 and got a 0.786. Okay, so this is measuring the first leg of the dump. Now, what we can also do is measure the last leg of the dump. Well, we can't assume that's a bottom yet, but let's just pretend that it is for the time being. So we measure, and the way you do it is get this little action tool looking thing, kind of looks like what you see in the Hollywood movies. All you got to do is grab one of those, find the peak. I'll just do it over here. So you can see the dotted line, it lines up with that peak, right? 1, go down to the bottom, 2, and then go up to the next high, 3. And you can see when you drop that anchor there, it projects down like that. Okay. Now, obviously, we want these to be in logarithmic view, which it is. So there's a difference between log and not log with the extensions. Not log, log, right? See how the positions change. So at first you had the 1272 here, and then it kind of shifts a little bit, not by much, but it does shift a bit and it makes a difference, right? So just to be safe, we'll leave it on the log scale because we are looking at a log chart. So what do we see? So what I'm looking for is a confluence in fibs. Where do these line up, right? Where do these numbers line up? Because the way you got to think about it is it's not people that do most of the trading these days, it's automated bots. And bots generally look at Fibonacci levels, EMAs, which are those ribbons right here. So you've got 55, 34, 21, 18, 13, and 8. These are all Fibonacci numbers. That's why I use those on my EMA ribbon. And that's a 200. I also call that 200 one because it's grey, the Sasha grey EMA, because Come on, man, who hasn't watched Sasha Grey? So I want to see a confluence of Fibonacci levels here. So what have we got so far? Well, 382 lines up almost with the 0.5 right there. So we know, and we have had some stalling right here, see that? In this zone, we've had some wick action and some stalling. So we know this is valid. And we know that in Gann theory, he seems to favor 0.5 retracements and extensions. Right, 0.5s and 1-to-1s. Gann likes those. And this almost hit a 1-to-1. Right. And I've seen quite a bit of these lately with in the charts. Usually in the charts, we'd find is 2017 and prior, the 618 used to be the favorite for Bitcoin and altcoins. Now I find that the levels are suddenly starting to shift. 0.5 is becoming a little more favorable now. We do get the odd wick down to the 618 or just before it, but lately I've noticed that 0.5 seems to be the go-to. So I've had to kind of adjust my trading style on that. So they're not really following just the one theory. They're kind of using a mixed bag to try and manipulate as much money as they can out of us, obviously to themselves. And it is a game of wits. It's a game of wits and emotion, fear and greed. So back to this. We can see here 382 is close to that 0.5. So we've had a bit of a bounce here. Now we've broken through 618 from the smaller extension. We're holding for the time being. 0.5 on the bigger extension. We haven't reached there yet, but we can see that support is pretty strong in this area. Right? Support's pretty strong in this area. Now, here's an interesting thing, right? If you look at the news articles, we've had Richard Kiyosaki from the Rich Dad channel who outright posted he's waiting until $24,000 before he's going to decide to buy more Bitcoin. Why is that? Well, you can see it right here. You see that? Now, where does this line up with? Remember how I said we want confluence. Which ones match the most? So which ones are closest to one another? Okay. 786, major level. 1618, also a major level. Where is it sitting at? 24 grand, almost. See that right there? Right, so I'm not saying the bottom is here, but what I am saying is that, look, these guys are rich investors. These guys know what they're getting into, and these guys know their levels. So whether he's saying it as a bluff to try and catch here, get everyone to panic sell, catch here, and then bounce back up, or whether he actually means that it is going to go to 24k. Well, I mean, look, technical support here. We've got an extension from the first leg down, and it lands here. Got an extension from the smaller wave. The 1618 lands there. Very, very interesting stuff. So we've got to look out for that. We've got to look out for that. What we also got to look at, and I know this video is getting a bit long at the moment, but just bear with me just for a little longer, is the EMAs. Right? EMAs are very important. So the reason why I use Fibonacci numbers is because they seem to have the best confluence. Right? So 55 EMA, 34 EMA, 21 EMA, 13 EMA, 8 EMA. So from what I found, when we're in a pretty solid momentous trend, we tend to bounce off the smaller value EMAs quite easily. So you can see down here, we couldn't even make it to the 21 or the 34. We're just outright bouncing off the 8 and the 13. You know, that's how strong they are. And then all of a sudden, we have that one wick that manages to touch a 21. Now what happens then? Things start to go sideways. See that? We'll briefly get over the 55. Now granted, this is the 4-hour chart, but you can apply this to pretty much any time frame. It'll work basically the same. And I've been using it for a long time now, and it works awesome. I learned this method off a YouTuber called Philicon. I think most of his content now is paid, but you know, this is the most important thing I've taken from him, really. So we can see the first time we wick that 21 EMA, it's as though confidence is kind of instilled back into the market, and we've realized, oh, yeah, we can do it. And you start to move sideways, and all of a sudden now we're closing the bands and we're starting to try and get above, right? And we get above. Now what happens here, right? My general rule is, generally, not always, for the most part, if we break below the 21 EMA, the red one there, and we fail to get back above it on the retest, right? Just like here. Zoom in a little, right? So we've broken below it, we've closed below it now, we've failed to get back above, right? Generally that means we're going down to the 55. Now on a higher time frame that'll make more sense. So let's check it out on the 1 day. Just stick that back on auto, right? I think it's a little different with Heiken-Ashi candles, but it's just all good. So you can see this here, right there. So we broke below the 21, we failed on the retest. What happens? That means we're definitely going down to the 55. That means we're going to be range bound. Generally speaking, that means we're going to be testing the 55. If the 55 breaks, we are in a bear trend. Right, we're in a downward momentum. Now I know a lot of guys use the 50 EMA, and they use that to consider the death cross. I like to use the 55. I prefer using a fib number, and I mean, look at that, timed almost perfectly. But we are currently crossing on my chart, currently just crossing. Right, so EMAs are very important, so you've got to pay attention to those. So what you want to look for on a bull run, how you can determine a bull run with the EMAs is, let's just go back, right? Let's just check this out. Right. So, generally speaking, the closer the EMAs are together when you're coming back from the downside to the upside, the harder it is to break that resistance because they're all clustered. And the reason why it's harder is because bots line their sell orders along EMAs and fib levels. So you can see here, 786, right? 786, and you got those EMAs kind of intertwined with one another. That makes it harder to break through. Now, when you have them a little spaced apart, it can get difficult, but it's also kind of easier in a way because it allows us, I don't know if I can find an example here. I mean, it can be few and far between, I suppose. But okay, here's one. So when they're spaced apart like this, it kind of makes it a bit easier in a way because we can break above and then use the gap in between them as a support range. You see that? If these were all clustered together, this is what would happen. Generally, when you're on a sideways move, this is what would happen. But as soon as they spread apart, they can be used as stepping stones, kind of like a ladder. And you can kind of jump up, bounce around, jump to the next one. Yeah, maybe you get rejected, but you've got that confidence now. Jump in. Now we're in a bull market, right? Or at least a bullish trend. Then all of a sudden you're bouncing off the 55. And as soon as you're above that 200, the Sasha Gray EMA, as soon as you're above the 200, off to the races now, right? Off to the races, look at that. Not always. Sometimes you do get a few crosses at the 255 before you confirm an actual bull run. In this case, we had the Corona dump right there. So that was a bit of a black swan event. So had that not have happened, I'd personally say that bull market probably would have started here or here, right? So generally speaking, 200 EMA under the 55, bull run confirmed. In this case, we've got the 200 EMA crossing above the 55. And what makes it worse is that the EMAs are now stacked in descending order. So that means higher value EMAs are on the top, then a lower, which makes it even harder to break through. So these are things you can watch out for as well. As soon as you see a sideways trend start to form, look for that first break and support in the gap between the EMAs and just keep an eye on that. And watch it try and ladder itself up. Right. So, and the last thing we can look at is obviously the positive divergences in the indicators. So here's a daily chart like that. There's your line. You've got an ascending support line on the RSI. And you can see low, then that's actually a lower low, but you've got a higher RSI. Generally speaking, that generally indicates a reversal of a trend, or at least a bullish sentiment to the trend. Not always. You can't always rely on just the one indicator. I mean, we do have it here too, right there, right, and an evening out of the histogram. But only time will tell. In this case, only time will tell. One more thing we can look at is the volume. So you can see in this dump here, the end of our A leg down. If you look up right there, you can see this is where it says volume there. See those numbers changing, right? They flicker. That's the amount of Bitcoin transacted in that bar, right? So in this case, each bar is a day worth of price action. So for example, over here on this massive red bar down, 32.469 thousand Bitcoins were transacted. Right, so that I'm pretty sure that includes buys and sells, right? But it's a huge amount of volume. Now look here, you can see the volume's been declining steadily, right? So now 8,500, 9.779 thousand. I'll go into recent days where we're testing the that there. You know, yesterday we were at 5,000. Currently we're sitting at 1.38, 1.4 thousand, call it. So that's currently what's going on. And you know, obviously what's glaring everyone in the face right now is this pattern here. Everyone's saying, whoa, it's a head and shoulders. Right, well, look, I don't think it is. If you were to take a measured move from this apparent head and shoulders, right, just to show you why. And the way we can tell the neckline is actually through the fib. It's right there. Right. I know there's wicks going past there, but generally most candle price action ends on that fib line, which is why fibs are so important. Yeah, down, down, down. It's a log scale. That's why it looks like it's extending like that. It's logarithmic. It's normal. Don't worry about it. Okay. Let's take a look at the price target. Quite the head and shoulders. Zoom out a little. Stick it on auto. Look at that. Insane. So according to that head and shoulders pattern, we are going into the negatives. You know, and if you don't believe me, here, we'll take it off log. Let's remove that. Okay. Let's jump in. Let's call this a head and shoulders. Alright. And let's just be conservative, right? We'll go from the candle bodies down. Right down here. And we'll move that. There's your price target, right? More or less. Yeah, slightly above. That's okay. I'll show you why it's okay. That puts us at $1,854. Now, I don't know about you, but I'm very skeptical of Bitcoin hitting $1,894, given the amount of institutional investment there's been in it, adoption, all that kind of thing. I'm not a permabull. I'm not a Bitcoin maxi. Nothing like that. You know, I do like Bitcoin. I do support Bitcoin. But that's, come on, that price target is pretty ridiculous. Right, so that wraps it up for this video. Hopefully the guys that requested it do learn from it. I'd like to give a shout out though to YouTube channels. Jason Pizzino, Benjamin Cowen, Ken at Crypto Trading, and Ivan on Tech. I really highly recommend those channels, guys. They're really good to learn from. Ivan on Tech is awesome when it comes to blockchain technology and the current status of projects, what ones are really good, what ones have promise. Like the programmer side of things, his channel's awesome. Jason Pizzino is really good when it comes to you know, things like Wyckoff and Gann, especially Gann. His brother actually is a really good trader as well. Professionals, both of them. His brother more so. So his advice is also really awesome, and he's got some great plans on accumulating wealth in regard to buying using the Fear and Greed Index, which is really good. Benjamin Cowen's also really good. He takes a mathematical approach to the charts. His logarithmic regression chart is just awesome, and very rational, very level-headed. And Ken at Crypto Trading, fellow Australian, just like Jason, just awesome. The guy's got plenty of years under his belt in regards to trading, and I can tell you, his info and his charts and his outlook and his calmness. I mean, look, if you're not interested in his TA or his actual info, then his voice alone is enough just for ASMR. It's fucking great. Excuse the language. But yeah, these guys are really great channels. I will see if I can put links to their channels on YouTube or maybe just their Twitter handles, and I hope you guys check them out. They're really, really good. They're a great resource. I've learned a lot from them personally. And yep. Till next time. See ya. Don't get wicked.